Hey guys, welcome back to the Bitcoin Fortress podcast. Today is Sunday, March 22nd, 2026. We are at block height 941,737. Moscow time is 14:53, and fees are still a very reasonable 1, 1, and 2 sats per VByte. In this episode, I'm covering the most important Bitcoin news from March 15th through March 22nd with a focus on the higher signal stories, macro, ETF flows, Treasury company buying, regulation, mining, and broader market structure. Then, as usual, I'll hit a few themes from the Bitcoin podcast universe, and then we'll wrap it up. The big takeaway this week is this. The short-term market was nervous, but the long-term Bitcoin story kept strengthening. The Fed stayed cautious, Bitcoin reacted like a macro asset, ETF flows started strong and then reversed. Miners felt pressure and options traders got defensive, but at the same time, strategy kept buying. Regulators moved toward more clarity and Bitcoin passed another major supply milestone. That is a very Bitcoin kind of week. Ugly on the surface, constructive underneath. So let's get started with macro, because macro is still the weather system Bitcoin trades in. The Fed held rates steady on March 18th, which the market largely expected, but Bitcoin still sold off afterward, falling into the low 71s and then slipping below 70,000 the next day as markets digested both the Fed's cautious tone and rising energy prices tied to Middle East tensions. Barron's framed it pretty clearly. Crypto got what it expected from Powell and still didn't like it. That is an important point for Bitcoiners. A lot of people still want Bitcoin to behave like a pure anti-system asset every single day, but in the short run, it still trades inside a broader global liquidity regime. If the Fed sounds less dovish than hoped, if inflation looks sticky, if oil is surging, risk assets wobble, and Bitcoin often wobbles with them. At the same time, that doesn't weaken the long-term thesis. In fact, it reinforces it. The Fed is trapped between inflation pressure and economic fragility. That is exactly the kind of environment where scarce, apolitical money makes more sense over time. So, the short-term takeaway is caution. The long-term takeaway is still Bitcoin. We also got a notable call from Citi this week. Citigroup cut its 12-month Bitcoin target to 112,000 from 143,000, mainly because U.S. crypto legislation has stalled and they now see less near-term regulatory momentum. They also laid out a bearish recession case around 58,000 and a bullish case up to 165,000. What I think matters there is not the haircut itself. It's that even after trimming the target, a major bank is still modeling serious upside from current levels. That tells you institutional finance still views Bitcoin as a legitimate macro asset with asymmetric potential. They may not understand Bitcoin the way Bitcoiners do, but they are at least taking it seriously. Another macro signal this week came from broader fund flows. Reuters reported that global equity funds saw $20.3 billion in outflows in the week ending March 18th, while money market funds took in more than $32 billion. That's a classic risk-off move. When big pools of capital are moving into cash-like safety, Bitcoin is going to feel some turbulence even if its long-term fundamentals are fine. And finally, sentiment got visibly defensive in derivatives. CoinDesk reported that traders were paying record premiums for downside protection in Bitcoin options, which is another way of saying fear got expensive this week. That does not guarantee a reversal, but it does tell you that the market mood got pretty negative pretty fast. In Bitcoin, those moments matter because extreme fear often shows up near emotional exhaustion. And turn on your DCAs. So if I had to summarize this first section in one line, it would be this. Bitcoin is still trading through macro stress, but that macro stress continues to make Bitcoin itself more relevant. Next up, spot Bitcoin ETF flows. This is one of the clearest real-time windows into institutional demand, and this week gave us a very clean narrative arc. On March 16th, US spot Bitcoin ETFs took in about $196.7 million in net inflows. On March 17th, they added another 174.5 million. That means institutions were still clearly stepping in early in the week, especially while Bitcoin was back above $74,000 and geopolitical stress was boosting interest in alternative stores of value. Then, of course, the mood changed. On March 18th, ETF flows flipped to roughly minus 153.1 million. On March 19th, another 90.5 million came out. So we went from strong inflows to back-to-back outflows right as the Fed tone, inflation concerns, and energy-driven market stress hit the tape. That's important because it shows that ETF demand is real, but it is not unconditional. These products are a bridge between institutional capital and Bitcoin. When confidence improves, they accelerate inflows. When macro gets ugly, they can amplify hesitation. ETFs are not a magic shield. They're a liquidity transmission mechanism. Still, I do not think this week was bearish in some structural sense. I think it showed that the institutional bid is still there, but it is highly sensitive to the macro narrative. Early week flows prove there is real appetite for Bitcoin exposure. Late week outflows prove that the capital can still turn cautious quickly. That's actually useful information for Bitcoiners. It means the structural adoption story is intact, but we should expect much more two-way volatility as Bitcoin gets integrated deeper into the existing financial system. And of course, we are in a bear market, and you can expect the sideways chop to continue, and perhaps even another terrifying dip down to shake out the last of the weak hands. And you should just be stacking sats and staying humble through all of that. Now let's move on to one of the biggest ongoing stories in the market, Bitcoin Treasury companies. The headline here is easy. Strategy bought another 22,337 Bitcoin, bringing its total holdings to 761,068 Bitcoin. The company said the purchase was made at an average price of about $70,194 per Bitcoin. That is a huge statement, and it came during a week when the market itself felt nervous. While traders were hedging downside and ETFs were wobbling, strategy was still doing what it does best, using market stress as an opportunity to accumulate more Bitcoin. To me, that remains one of the strongest institutional signals in the market. You can debate the capital structure, you can debate the leverage, you could debate how aggressive the model is, and all of those are fair debates, but the signal is unmistakable. There is at least one major public company that continues to behave as though the correct answer to monetary disorder is to just own more Bitcoin. That said, there's a nuance here. CoinDesk published a piece this week on Strategy's newer preferred share funding structure, arguing that the model is both clever and potentially dangerous. That's a fair way to put it. These Bitcoin Treasury vehicles are innovative, but they are also experiments in how far capital markets will go in funding synthetic or leveraged Bitcoin exposure. That matters because there is a difference between the Bitcoin thesis and the financing wrapper built around it. The thesis can be right while the wrapper remains fragile. That's why I think this is one of the best things to focus on. Holding actual Bitcoin and holding a financialized Bitcoin proxy are not the same thing. We also saw another sign of how fast this Treasury trend is spreading. The Bitcoin Magazine podcast and related market coverage have been leaning into what some are calling the Nakamoto flywheel strategy, basically the idea that public market access, balance sheet Bitcoin, narrative, and capital raising can all reinforce each other. Whether every company can pull that off is another question entirely, but the fact that this is now a whole genre of Bitcoin finance tells you the market is evolving fast. So, I think the right framing for listeners this week is Treasury company adoption is bullish for Bitcoin demand, but it also increases the amount of financial engineering orbiting Bitcoin. And when the next true stress event comes, we're going to learn which vehicles are robust and which ones were just surfing the cycle. One of the most important stories this week may not have moved the price much right away, but it matters a lot over time. On March 17th, the SEC announced an interpretation clarifying how federal securities laws apply to certain crypto assets and transactions. The agency said the release provides a clearer taxonomy and addresses how securities laws may apply to things like airdrops, staking, mining, and wrapping. The CFTC joined the interpretation. That's a big development. It does not solve every problem, it does not replace legislation, and it certainly does not make the broader crypto regulatory landscape simple. But it does give the market something it is badly needed, more explicit lines. For Bitcoin specifically, that is generally bullish. Why? Because Bitcoin has always been the cleanest asset in the space from a securities law perspective. The more regulators draw lines around everything else, the more Bitcoin stands out as the asset with the least ambiguity. Axios also reported that a senator signaled progress on a broader market structure bill. Again, not done, not final, but clearly pointing in the direction of more legal clarity rather than less. So my read is this: Washington is still messy, but it is not moving backward. That alone is a major change from the atmosphere of a couple of years ago. The debate now is less about whether crypto will be regulated at all and more about how it will be regulated, who will benefit, and how much room will be left for open competition. For Bitcoiners, this is another reminder that Bitcoin simplicity is a feature. The more complicated the regulatory discussion gets around the rest of the industry, the more attractive the simplest asset tends to look. Now let's talk mining and network fundamentals. First, Bitcoin crossed a milestone that is psychologically important, even if it was mathematically inevitable. 20 million Bitcoin have now been mined. That means that 95% of the total 21 million supply has already entered circulation. That is such a great reminder of what Bitcoin actually is. In a world where central banks can expand balance sheets, governments can issue endless debt, and fiscal systems can always find another emergency, Bitcoin just keeps moving through its supply schedule exactly as designed. No committee, no bailout vote, no emergency discretion, just math and time. At the same time, miners had a tougher week. CoinDesk reported that Bitcoin's hash rate had fallen roughly 8% over the prior week to around 920 exahash per second, likely tied to energy market disruptions as the Middle East conflict pushed energy prices higher. This is a useful teaching moment. Bitcoin mining is not abstract. It is a physical world business. It sits right at the intersection of capital, hardware, and energy. When energy costs jump, miners feel it immediately. When margins compress, the weaker operators get squeezed. And that squeeze showed up in difficulty as well. Reports this weekend indicated a roughly 7.8% drop in mining difficulty, one of the larger downward adjustments of the year, alongside signs of serious miner stress. Again, I do not think Bitcoiners should hear that as bad news in some existential sense. This is what the network does. Stress gets translated into economic discipline. Inefficient operators suffer, efficient operators adapt, difficulty adjusts, the network survives, and that is anti-fragility in action. So, even here in a week when mining conditions worsen, the deeper takeaway is that Bitcoin remains one of the few systems that does not need narrative management to survive pressure. It just reprices, rebalances, and keeps going. Let's close the news portion with a few themes from the broader Bitcoin podcast universe this week. One big theme was macro and liquidity stress. On TFTC number 729, Marty Bent talked with Jeff Park about a generational liquidity trap tying together demographics, inequality, AI disruption, and why Bitcoin may function as a hedge against deeper systemic breakdown. That lines up almost perfectly with the macro tone we saw in markets this week. Another theme was product maturity and self-custody. Rabbit Hole Recap 401, titled Better Bitcoin Wallets, shows that the conversation is maturing beyond price action into usability, custody, and infrastructure. That is healthy. The longer Bitcoin survives, the more the conversation has to move from speculation toward practical ownership and long-term resilience. One of my favorites this week, and one that I actually listened to, was a third theme, which is on-chain interpretation and investor behavior. Natalie Brunell's Coin Stories episode with James Check focused on market cycles, investor psychology, and how to read the chain during uncertain periods. That also feels very timely. In a nervous market, people start looking for stronger signal beneath the price candles. I think this was the first time she had him on her show. Listened to him before, he's great. And she really tried to get him to focus on the fundamentals of on-chain analysis. And it was actually really, really instructive. And basically, the conclusion is now's a great time to DCA. And will Bitcoin go lower? Sure. Will it continue to chop sideways? Probably. But you will probably be happy that you were buying at this level in 5 to 10 years. Is kind of my big takeaway from that. And then there's the rise in the Bitcoin Treasury conversation as a recurring media theme. The Bitcoin Magazine podcast coverage of Nakamoto Flywheel is basically a sign that balance sheet Bitcoin is no longer a niche topic. It is now a core part of the broader conversation. So if I had to summarize the podcast universe in one sentence this week, I'd say Bitcoin media sounded like a mix of macro anxiety, self-custody seriousness, and institutional normalization. This week's featured Bitcoin Fortress Substack post is Bitcoin versus monetary expansion. And honestly, that theme fits the week perfectly. We just watched another week where markets were trying to price the impossible balancing act of modern central banking. Control inflation, support growth, calm markets, contain geopolitical stress, and somehow keep the debt machine running. Bitcoin stands outside that entire framework. That's why the long-term case remains so strong. The system is structurally biased toward more debt, more intervention, and more monetary expansion over time, and Bitcoin is the opt-out. And as always, be sure to check out my 3 Bitcoin Fortress books, and again, links in the show notes to the books, as well as everything that we covered here in the podcast, including the featured Bitcoin Fortress Substack post and all of the news articles. The books are Bitcoin Fortress, A Simple Guide for Beginners, Bitcoin Retirement and Estate Planning, and The Bitcoin Lifestyle. If you want a deeper foundation beyond the weekly noise, those books are a great place to start. Well, folks, that's it for episode 208. The short version this week is this. Macro stayed messy. ETF flows turned midweek. Miners felt the squeeze. And the market got nervous. But the deeper foundation of Bitcoin kept strengthening. Strategy kept buying. Regulators got clearer. The supply schedule kept doing what it does. And the broader conversation around Bitcoin kept getting more serious. So yes, the market looks shaky, but the signal looks strong. Thanks for listening to the Bitcoin Fortress podcast. Please share the show. Check out the Substack. And I will see you all next week. Bye-bye.